Hello students and welcome to Accounting 1101. In this video, we'll be going over Chapter 3 in your financial accounting textbook. And this chapter covers the adjusting process. So let's just delve right into what is the adjusting process. So as we ended in Chapter 2, discussing analyzing transactions, we ended up going over the trial balance and discussing possible errors of the trial balance. Well, the trial balance we looked at was considered an unadjusted trial balance, which was prepared at the end of the accounting period. And of course, that accounting period could be the end of the month, the end of the quarter, or the end of the year. And the example they showed was the end of the year. So in that unadjusted trial balance, what we do is we verify the total debit balance equals the total credit balances. And we do this before the financial statements can be prepared. However, some accounts on the unadjusted trial balance must be adjusted. And these adjustments are necessary because the transactions for the company were recorded using the accrual basis accounting. So let's get started. So what is accrual-based accounting? So under the accrual basis of accounting, revenues and their related expenses are reported on the income statement in the period which the service had been performed or the product had been delivered. Basically, this means that instead of so when you actually perform the service, you've earned the revenue. Regardless if you've been paid or not, you've earned the revenue. So what happens is you get to record the revenue to the ledger, but since you weren't paid for it yet, you put it to an account such as accounts receivable. And this is so that make sure that the total amount of revenue you've earned for that month is recorded in the month you earned it. The same thing for expenses. If you've incurred that expense, regardless if you've paid for it or not, you've incurred that expense that month. Therefore, that expense has to be recorded on the books. So an example of an expense that you've incurred but maybe not yet paid would be buying supplies on account. So you've bought some supplies like office equipment or office supplies, and you bought it on account. And you would record the expense. And of course, since it's on account, you aren't going to record it against your cash account. You're going to record it against accounts payable. Now, that is accrual-based accounting, basically meaning you record the revenue and you record the expense in the period in which the transaction occurred, and not when you receive cash. So speaking of cash, the other type of accounting method would be the cash basis accounting method. And this is when you only record the transactions when the cash transaction actually occurs. So you don't record the revenue until you received cash payment for the service or product. And you don't record the expense until you actually pay the expense against your cash account. So those would be the two differences. Majority of businesses do use accrual-based accounting, and we will use accrual-based accounting for all future transactions regarding our company Net Solutions. So with that said, we're going to talk about a couple other important terms, and that is your revenue and your expense recognition. All right, so under the revenue recognition principles, revenues are recorded when they are earned, meaning you've provided the service or you provided the product to your customer. Therefore, you have now earned that revenue, and that is considered revenue recognition. Under the expense recognition, the expenses incurred in generating the revenue must be reported in the same time as the related revenue. So if you had to use your computer repair supplies to perform services, then you're going to have to make sure that those supplies are expensed out. And this is considered the matching principle to ensure that the expenses you incur to generate the revenue are recorded within the same period. So what is the adjusting process? At the end of an accounting period, and again, what is an accounting period? An accounting period can be month, quarter, or year. But at the end of the accounting period, an adjusted trial balance is prepared to verify the total debits and credit balances. And many of these account balances are reported on the financial statements without change. For example, the balances of the cash and the land accounts normally are not adjusted. And those amounts are reported on the balance sheet, and they don't normally need to be adjusted. But some accounts on the unadjusted trial balance do require adjusting for some specific reasons. Some revenues and expenses may be unrecorded at the end of the accounting period. For example, a company may have provided services to customers that it's not billed or recorded at the end of the accounting period. So what are some examples? You have provided services for a customer, but you've not yet billed that customer, but you need to capture the revenue that you've earned. So you'll need to do an adjusting entry for that revenue that you've earned, even though you've not quite billed the customer yet. Also, some expenses, you may have incurred some expenses that you've not recorded on the books that you'll need to record because you've incurred them. Here's a really good example. Some revenues and expenses are incurred as time passes rather than as separate transactions. So for example, rent received in advance, which would be unearned revenue, or unearned rent revenue to be very specific. So someone's paid you 3 months worth of rent all at once. You haven't really earned that revenue, therefore you can't record it to revenue. So if you remember back in Chapter 2, when we talked about earned revenue, the example they gave was we were paid in advance for 3 months worth of rent. So at the beginning of December, when we recorded that, we recorded a debit to cash because they paid us cash money, a total of $360. And then we recorded it not to revenue, but to unearned revenue. Well, at the end of the month, you've now earned one of those months. So you can actually take it out of unearned revenue and put it to actual revenue. And that would be considered an adjusting entry. So we'll get to more examples of adjusting entries as we get further into the chapter. But the journal entries that bring the accounts up to date at the end of the accounting period, these are called adjusting entries. All right, so an example would be unearned rent. Another example would be prepaid expenses. If you can remember when we talked about prepaid expenses, the example we gave was when we prepaid an entire month of our insurance premium. So we paid out 12 months in advance. It was $2,400. So as each month passes, we can take it out of prepaid expense and actually recognize it as an expense. And then that's another example of an adjusting entry. So let's look at example, and let's talk a little bit more about each of these different accounts and why they may or may not require adjusting entries at the end of the month. So as I stated earlier, cash is usually one of those accounts that never need an adjusting entry at the end of the month. So the answer would be no for cash. But supply expense is a yes, because we record supplies as an asset, and then as we use the supply for our services, we then record that supply as an expense. We expense it out. So yes, supplies expense would definitely need an adjusting entry at the end of the month. Wages expense. Why would wages expense possibly be an adjusting entry? Well, sometimes your accounting period may end before the pay period does. So if you're paid at the end of every single week, so Friday is your payday, but the accounting period ended on a Wednesday, you may have to do an adjusting interest to record the wages expense incurred in the first half of that week to make sure it's recorded in the counting period that it occurred. So the answer to C would be yes. And we will definitely show more examples of that later in the chapter. The next one, land. No. Land is another one of those assets that does not need an adjusting entry at the end of every period. So the answer to land is going to be no. Accounts receivable is a definite yes. Again, in the example we showed, sometimes you'll provide services to customers and you've not been paid yet. So you're definitely going to have to record it to accounts receivable and until you're actually paid. So the answer to E is going to be yes. And then unearned rent. Well, we just used unearned rent as an example of unearned revenue and how at the end of the month, when we've now earned 1 month of that rent, we get to do an adjusting entry to record it to revenue. So the answer is yes. So let's go into types of accounts requiring adjustments. There's 2 general classifications of accounts requiring adjustments. They are accruals and deferrals. So what are accruals? An accrual occurs when the revenue has been earned or an expense has been incurred but not been recorded. So if the accrual is for revenue, the adjusting entry debits an asset such as accounts receivable and then credits a revenue account. If the accrual is for expense, then the adjusting entry usually debits an expense account and then credits a related liability account, such as accounts payable or wages payable. And then here's some examples of accrued revenue and accrued expenses and what the adjusting entry would look like. So what is a deferral? A deferral occurs when cash related to a future revenue or expense has been recorded as a liability or an asset. So your unearned revenue and your prepaid expenses are deferrals. This means that the cash portion of the transaction has occurred, but the other action has not. In other words, you've not earned it, and it's not actually and the expense has not been incurred. So it's kind of the opposite. An accrual, you've provided the service or the product without being paid, or you've incurred the expense without paying the bill yet. So accruals means that no cash transaction has occurred yet. Deferrals means the cash transaction has occurred, but the other half has not. So here's an examples of some journal entries for the unearned revenue and the prepaid expense portions of adjusting entries. So here, cash has been received for revenue that will be earned in a future period. Hence your unearned revenue. So your initial journal entry, you received payment, so you're going to debit cash. You've not earned the revenue, so you can't record it to your revenue account, so you record it to your unearned revenue. Now, revenue has been earned. In other words, you've done whatever service or you provided whatever product was required, so you've now earned that revenue. So you're going to see here where you credited unearned revenue. Well, in the adjusting entry, you're going to debit unearned revenue, and then you're able to now finally credit revenue. In the prepaid expense, your transaction cash has been paid for a future expense. So you've paid for a future expense. In other words, you paid for an expense that you've not incurred yet. So obviously we're going to credit cash because it's a payment, but you can't expense it yet. So you're going to record the debit to a prepaid expense. Now, the expense has been generated to revenue. So meaning has been incurred now. So you're going to take it out of prepaid expense with a credit to prepaid expense and go ahead and debit the correct expense account. All right, so let's look at some examples. It says here, classify the following items as either a prepaid expense, an unearned revenue, an accrued expense, or an accrued revenue. Wages owed, but not yet paid. This would be an accrued expense. Supplies on hand, a prepaid expense. Fees received but not yet earned, unearned revenue. And fees earned but not yet received, accrued revenue. So let's look at adjusting entries for our accruals. And here we'll talk more examples of types of adjusting entries for our accruals. All right, so first we're going to look at the unadjusted trial balance for net solutions here in this exhibit, and an expanded chart of accounts in this exhibit. All right, so it's very important. I want you to take note that there are some new accounts. They're highlighted in red in our chart of accounts. All right, so let's move forward. Accrued revenues. All right, so during accounting period, some revenues are recorded only when cash was received. But at the end of the accounting period, there may be revenue that's been earned but not been recorded. So in such cases, revenue is recorded by increasing the asset account and increasing the revenue account. So specifically what's going to happen is you're going to debit accounts receivable and credit fees earned. So here's an example. Assume that Net Solutions signed an agreement with Danker Company on December 15th. The agreement provides that Net Solutions will answer computer questions and render assistance to Danker's company employees. The services will be billed to Danker Company on the 15th of each month at a rate of $20 per hour. As of December 31st, Net Solutions has provided 25 hours of assistance to Danker Company. So the revenue that they've earned is $500, which is $20 per hour times 25 hours. However, it will not be billed until January 15th. But Net Solutions has earned the revenue in December. So we need to record the revenue they've earned in December in the month they've earned it. So what you'll see here is what we call an adjusting journal entry. So we're going to debit accounts receivable, and we're going to credit the revenue account fees earned because they've earned the money even though they haven't been paid for it yet. So as you see here in accounts receivable, they debit accounts receivable and credit revenue. Now, it's very important that we do this adjusting entry. If the adjustment for the accrued revenue was not recorded, then fees earned and the net income will be understated by $500 on the income statement. And on the balance sheet, assets and owner's equity will be understated by $500. You can see the effects that would occur if you did not record that adjusting entry. So you have both your income statement and your balance sheet affected. So let's look at an example. At the end of the current year, $13,680 of fees have been earned but not billed to clients. And wants you to journalize the entry to record the accrued fees. So you would start out with a debit to accounts receivable for the full amount of fees that have been earned but not recorded. And you would go ahead and credit your revenue account fees earned. Now, there will be further adjusting entries to this adjusting entry once payments are received. But this is the adjusting entry to ensure that all the revenue that was earned in that accounting period was captured on the books. That is very important. Just like it's very important that you capture all the revenue earned in that accounting period, it's also very important that you capture all the expenses that you've incurred, because you want to make sure you have all the expenses that you've incurred while generating all that revenue. So the best example to talk about for an accrued expense is going to be accrued wages. So let's start by looking at this calendar here. All right. So as we can see here, the month of December ends on Tuesday, but the accounting period has not ended yet. So Net Solution pays its employees bi-weekly. And during December, Net Solutions pay wages of $950 on December 13th, and they pay $1,200 on December 27th. And these payments covered pay periods ending on the days as shown in this exhibit. All right. But as of December 31st, Net Solution owes $250 of wages to employees for Monday and Tuesday, December 30th and December 31st. Thus, the wages expense account is increased with a debit of $250, and the wages payable account is increased with a credit of $250. And this is considered an adjusting entry. Now, the next pay period, which is biweekly, would not occur until January 10th. So we have the 13th, we had the 27th, and we'll have the January 10th. All right. So this is an example of when a pay period ends after the accounting period ends. So we see here the accounting period ended December 31st, but the pay period doesn't end until January 10th. So we have to actually accrue these 2 days worth of expenses for wages, because again, these are expenses that we incurred while generating revenue. So we have to, if we're capturing all the revenue we've earned, we have to capture all the expenses we've incurred. So this is what the journal entry would look like for those 2 days. So we would go ahead and hit the expense account for wages expense of $250. And then we would go ahead and create a liability for the amount that we owe, and we'll owe that amount on payday. So we go ahead and create a liability account called wages payable that we're going to credit for the $250. So if you see here, liability, so your assets equals liabilities plus owner's equity. An expense decreases equity while a credit to payables increases liabilities, they offset each other. So our accounting equation is still balanced. Now the question is asked, everybody should be scratching their head thinking about, well, how does this affect payday? Okay, so let's look down here. After the adjusting entry is recorded and posted, the debit balance of the wage expense account is $4,525. And this balance of $4,525 is the wage expense for 2 months, November and December, because Net Solutions opened up in November. The credit balance of $250 in wages payable is a liability for wages owed in December. All right. So if you notice here, they don't equal each other because this $250 in wages payable isn't going to stay there. All right. So with that said, let's move on. Now it's January 10th and it's payday. All right. So Net Solutions has paid their wages and they paid a total of $1,275 on January 10th. And this payment does include that $250 of accrued wages recorded on December 31st. So how does the journal entry look for January 10th? So you see here, because they did pay out payroll, so they cut payroll checks, we're going to credit our cash account, the total amount of payroll, which is $1,275. But if you look here, we're not expensing that full amount because we've already expensed $250 of it. So, and we put that $250 in wages payable up here as a credit to wages payable. So we actually going to reverse that out on January 10th. So if you see here, we're reversing that payable out by doing a debit entry to payable, and then the amount, which would be the expenses from the 1st to the 10th, equals $1,025. So that's the amount we still have to expense onto our books, which we see here. And then we have our debit to payables, pulling it out of payable because we no longer owe it. Because why? We are now paying it. Hence our credit to cash for the full amount of $1,275. Now, if the adjustment for wages was not recorded, wage expense would be understated and net income would be overstated on the income statement. And on the balance sheet, liabilities such as wages payable would be understated and the owner's equity would be overstated by $250. So let's look at an example for an adjustment entry for accrued expense. So this one's actually a little complicated. I don't have a whiteboard, so you're going to have to bear with me as I explain what we're doing. San Regret Realty Company pays weekly salaries of $12,500 on Friday for a 5-day work week. Now, journalize the necessary adjusting entry at the end of the accounting period, assuming that the accounting period ends on Thursday. So the payroll week ends on Friday, and payday is the same day that payroll ends. So payroll always ends on Friday. But in this situation, the accounting period ends before the payroll period does. So the accounting period is going to end on Thursday. So the first thing we're going to do is this $12,500 is 5 days of wages. Okay. So the first thing I want you to do is I want you to take this $12,500. All right. I want you to have a piece of paper and I want you to write this down. You're going to take this $12,500 and you're going to divide it by 5. All right. So once you divide it by 5, then that's going to give you a number of 2,500. That is your daily rate for your wages. In other words, that's how much you pay your employees daily. If you were to pay them daily, you would pay them $2,500 daily. Okay. But we don't. We pay them weekly. All right. But we have to figure out how much expenses we've incurred for 4 days. So to be able to calculate how much expenses we've incurred for 4 days, we have to figure out the daily rate. So again, take that $12,500 and divide it by 5, and that gives you your daily rate. Now, to figure out how much expense we've incurred for Thursday, we need to figure out 4 days: Monday, Tuesday, Wednesday, Thursday. So I want you to take that 2,500 and I want you to multiply that by 4. Now, you should have gotten $10,000. That is the amount of wage expense we have to capture for the accounting period, and we have to put up as a liability. And so what we would do is we would debit wage expense and credit wage payable for $10,000, which is 4 days of expenses. So let's look at the example. So you see right here, that's exactly what they did. They're calling it salaries. Salaries or wages is fine. Salary expense, $10,000. Salary payable, $10,000. So salaries accrued, okay? See here, they took $12,500, divided it by 5 days. That gave us $2,500. And then we multiplied that by 4 days, Monday, Tuesday, Wednesday, Thursday. That's what we did, 4 days. And that's how much expense you need to accrue for that work week that the accounting period ended before the payroll period ended. Okay. So next, we're going to talk about adjusting entries for deferrals. Now, our deferrals are our prepaid expenses and our unearned revenue. So let's look at unearned revenues. So if we remember correctly, back on December 1st, and this was in a previous chapter when we first started talking about unearned revenue, the example was on December 1st, Net Solutions received payment of rent in advance. They received 3 months of payment in advance. In that journal entry that they did, when we first received the check, is we debited cash to increase our cash balance because we received the check for rent. And we did a debit to cash for $360 because that was what the total amount was. And we did a credit to unearned rent revenue because we had not earned it yet. All right, so now this balance represents the receipt of 3 months rent that we received December 1st, and it's for the month of December, January, and February. Now we're at the end of December, so 1 month's rent has been earned. All right, so we need to do an adjusting entry where we reduce our unearned rent account and record it to our rent revenue account. All right, and we're only going to do it for 1 month. So to figure out what 1 month is, you would take 360 and you would divide it by 3. See right here. So by doing that, the 120 represents the rental revenue for 1 month. All right, and here's the adjusting entry. Now again, when we set it up, we did a debit to cash and a credit to unearned rent revenue. All right, now we're adjusting it. So by adjusting it, we're going to take it out of unearned rent revenue and record it to rent revenue. So let's look at the T accounts, give us a better idea of what's happening here. So when we set up, when we first entered the unearned rent, we entered it for the full 360 because we hadn't earned any of it. So if you see here, we have a balance of $360 in our unearned rent revenue account. All right, our adjusting entry, if you see here, we've now done a debit entry to our unearned rent revenue of $120, which now reduces our balance to $240. And we have now recorded it as actual rent revenue. This now increased our rent revenue balance by $120. You would do this for each month. You would do it for December, January, and February. And you would do that at the end of each month as an adjusting entry, taking it out of unearned rent into rent revenue. Now, of course, if this had not happened, if we had not taken it out of unearned into earned revenue, then of course our revenue would be understated, which means our net income would be understated, which means, and then because unearned revenue is a liability account, our liabilities account would be overstated and our equity account would be understated. So let's do an adjusting entry for unearned revenue. So it says here, the balance in the unearned fees account before adjusting at the end of the year is $44,900. Journalize the adjusting entry required if the amount of unearned fees at the end of the year is $12,300. So let's click on the answer. So we needed to figure out how much to record. So we had to do a little bit of math. So we would start by taking the $44,900 and subtract out the $12,300, and that gave us $32,600. And this is the amount that we need to take out of unearned and record to earned fees. So you would debit unearned revenue, which is unearned fees, revenue account, taking it out reducing that liability, and we would go ahead and record it to our fees earned because we've now earned those fees. All right, now the last deferral account is prepaid expenses. So December 31st, unadjusted trial balance of net solutions indicated a balance in the supply account of $2,000. In addition, the prepaid insurance account had a balance of $2,400. So if you remember correctly, we prepaid 12 months worth of insurance for a grand total of $2,400. So we're going to have to do 2 adjusting entries for our prepaid expense accounts. All right, so let's first talk about supplies. The balance in net solution supply account on December 31st is $2,000. Some of these supplies were used during December and some are still on hand. So if the amount is unknown, the other can be determined. So it's usually easier to determine the cost of supplies on hand at the end of the month than it is to record supplies used on a daily basis, because not everybody has time to sit down and calculate how much supplies they've used on a daily basis. So a lot of times what companies do is they'll do a quick inventory count of the supplies on hand they have at the end of the month and then do one big adjusting entry. And so that's exactly what Net Solutions did here. So on December 31st, the amount of supplies they had on was only $760. So the amount to be transferred from the asset account to the expense account is going to be $1,240, which is the difference between their beginning balance and their ending balance. So again, when we buy supplies, we record the supplies as an asset. As we use the supplies, we then expense them out. And so that's what this adjusting entry is doing. So we would reduce our supply asset account by $1,240 and expense it to our supply expense account. I'm just showing you see here the impact it would have on the T accounts as well. So obviously we started out the month with a balance of $2,000 with our adjusting entry, crediting the supply asset account by $1,240. It brings the balance down to $760. And the expense account, we had a beginning balance of $800 because that is the amount we expensed out in November's transactions. Now we're adding the $1,240 that we expensed out in December. So our new balance in our supply expense account is $2,040. This is the total amount of supplies that we have used so far, which is for November and December. Let's talk about prepaid. So the debit balance of $2,400 in Net Solutions prepaid insurance account represents a December 1st prepayment of insurance for 12 months. So at the end of December, the insurance expense account should be increased and the prepaid expense account should be decreased by 1 month because we now incurred 1 month of that expense. In other words, the insurance company has provided that service to us for at least 1 month. So it's no longer a prepaid expense. It's now expired and we can expense it. So we paid $2,400 for 12 months. So 12 divided by 2,400, that roughly equals $200 a month. So that's how much we're going to do our adjusting entry for the end of December. So if you see here, we did a credit to our prepaid expense because we're reducing it. And we did a debit to our insurance expense because we are now expensing it out to our insurance expense account. So let's look at the T accounts and how it has affected them. So our prepaid insurance at the beginning of December had a balance of $2,400 with a credit to that account of $200. It's now brought our balance down to $2,200. And this is our first month actually recording that insurance expense. So our insurance expense account now has a $200 balance. Now, at the end of 12 months, if we do this adjusting entry every single month at the end of every month for 12 months, we should have a zero balance in our prepaid insurance, and our insurance expense should have a $2,400 balance. All right. So looking at the example, the prepaid insurance account had a beginning balance of $2,400 and was debited $3,600 of additional premiums paid during the year. Journalize the adjusting entry required at the end of the year, assuming the amount of unexpired insurance related to future periods is $3,250. All right, so we had a beginning balance of $2,400. and it was debited for $3,600 for additional premiums paid. So we started out at $2,400. We made some extra prepaid premiums of $3,600. And at the end of the year, the amount of unexpired insurance to future periods equaled $3,250. So we need to figure out how much we need to expense. So we would start by taking the $2,400, adding in the $3,600, and then subtracting out the ending balance. And that will give us the amount of prepaid insurance we can now expense out to the expense account. That's how much is now expired and we can expense. So we're going to go ahead and credit prepaid expense because it's now expired. It's no longer prepaid. It's expired. So we're going to credit it out. We're taking it out of the prepaid insurance account, and we're going to go ahead and post it to the insurance expense account with a debit. All right. Now we're moving on to a whole new set of adjusting entries, and these are adjusting entries for depreciation. You have fixed assets, or what sometimes is called plant assets, and these are physical resources owned and used by businesses and have a permanent or a long life. So examples of fixed assets include land, buildings, and equipment. So fixed assets are a type of long-term prepaid expense. You can kind of look at it that way, a long-term prepaid expense. So because of their high dollar amount and long life, they're discussed separately from prepaid expenses. So fixed assets such as office equipment are used to generate revenue, much like supplies are used to generate revenue. So unlike supplies, though, there is no visible reduction of the quantity of the equipment. So you can look at supplies on hand and physically see how much you have left. But when you look at an equipment, you can't physically look at how many years or how many more products or units it can produce. Instead of looking at the actual quantity of supplies on hand, as time passes, equipment is going to lose its ability to provide useful services. The best way to talk about depreciation, a lot of people can relate to, is your car. The more miles a car has on it, the more wear and tear the engine has on it, the more it's depreciated in value. Fixed assets are a very similar manner. All right, all fixed assets except land lose their usefulness and are said to depreciate. Okay, so as a fixed asset depreciates, a portion of its cost should be recorded as an expense. All right, and this expense is called a depreciation expense. All right, now what you're doing is, so it's very similar to the supplies on hand, in that when the supplies is used, we do a credit entry to that asset account, reducing that value of that asset, and we debit the expense portion of that asset. So we credit supply asset and we debit supply expense. All right, so this is very similar type of reduction of asset. But we use two new accounts. We use depreciation expense and we use what's called accumulative depreciation. And accumulated depreciation is actually what we call a contra asset account. Okay, this is because accumulative depreciation accounts are deducted from the related fixed asset accounts on the balance sheet. So like in supplies, we just do a direct credit to the supply asset account. Well, on fixed assets, we don't do that. We don't do a credit to the equipment account. We do a credit to the accumulative depreciation account for that fixed asset. So let's look at some examples. All right. Here's some examples of a journal entry for depreciation. So December 31st, an adjusted trial balance of Net Solutions indicated that Net Solution owns two fixed assets, land and office equipment. So land does not depreciate and therefore does not have a contra account or any adjusting entry, as we already discussed, but office equipment does. And it does depreciate and requires an adjusting entry. So assume that office equipment depreciates $50 during the month of December. The depreciation expense account is increased with a debit by $50, and the contra asset account accumulative depreciation for office equipment is increased with a credit for $50. And this is what the journal entry will look like. So here you see the debit to depreciation expense and a credit to cumulative depreciation for office equipment. So let's look at the accounting equation impact. Okay, so we have assets equals liabilities plus owner's equity. All right, so the office equipment has a value of $1,800. Now you see here, we like in supplies, we would just see a credit entry over here, but we don't do that for equipment. We don't do that for fixed assets. What you see here is instead you see a credit to the cumulative depreciation account. And then of course you see a debit to the depreciation expense account. So after the adjusting journal entries recorded and posted, the office equipment account itself still has a balance of $1,800. This is the original cost of the office equipment that was purchased on December 4th. The cumulative depreciation office equipment account has now a credit balance of $50. The difference between these two balances is the cost of the equipment that has not yet depreciated, meaning the book value or the net book value of the asset. So the book value of the asset equals cost minus cumulative depreciation. So if you see here, the office equipment original cost of $1,800 less depreciation now has a book value of $1,750. And this is how it also would appear on your balance sheet. On your balance sheet, you would show that fixed asset of office equipment, and then you would see below it less cumulative depreciation of $50, and then out next to it, it will show the net book value of $1,750. So let's look at an example exercise. The estimated amount of depreciation on equipment for the current year is $4,250. Journalize the adjusting entry to record the depreciation. So again, you would start out doing a debit to depreciation expense account for $4,250, and you would credit the cumulative depreciation account for the equipment. All right, so let's do a quick summary of the adjusting process. So we have right here in this exhibit, we have examples of accrued revenues, accrued expenses, unearned revenues, prepaid expenses, and depreciation. These are all examples of typical adjusting entries that would occur at the end of an accounting period. And that accounting period, again, could be monthly, quarterly, or annually. So in this table, it gives examples, reasons for the adjustment, what the adjusting entry would be, and then an actual example taken from Net Solutions and how it would affect the financial statement if the adjusting entry is omitted. I'm not going to go through each of these individually, but I do encourage you to look at these in your textbook because it's just a great refresher of everything we've discussed in this chapter. And this exhibit are all examples of those adjusting entries and then how it would impact the ledger. So again, I'm not going to go through each of these individually because we've already talked about all of these entries, but this is just a great summary to kind of go back and look at and see the big picture of how it affects the general ledger and the accounts. So this is a great way of just kind of like getting a refresher of what are they for, what do they do. These is just taking this information right here and just putting it into just one big journal entry, just kind of look at to get a better idea of the credits and the debits. And then this is great because it takes your journal entries and shows what happens to each account as this journal entry is then posted to the ledger, affecting and updating each account's balance and how they affect each account. So I encourage you guys to kind of look at that on your own. All right. Now, at the end of chapter 2, we talked about an unadjusted trial balance. Well, in chapter 3, we've now done our adjusting entries. So after those adjusting entries are posted, we run what's called an adjusted trial balance. The adjusted trial balance verifies the equality of the total debits and credit balances before the financial statements are prepared. If the adjusted trial balance does not balance, and of course that means an error has occurred, and we discussed how to look for those errors back in in the previous chapters. But if you look here, you're going to see all the accounts that have been there, but you're also going to see some new accounts. You're going to see some wages payable. You're going to see some unearned revenues and revenues. So you're going to see some new expense accounts, some new revenue accounts, some new payables, and you're going to see some new contra asset accounts. So let's talk about some effect of some errors on an adjusted trial balance. So for each of the following errors, consider individually, indicate whether the error would cause the adjusted trial balance totals to be unequal. If the error would cause the adjusted trial balance totals to be unequal, indicate whether the debit or the credit total would be higher and by how much. So the first one, the adjustment for the accrued fees of $5,340 was journalized as a debit to accounts payable for $5,340 and a credit to fees earned for $5,340. Well, right off the bat, the debit and the credit totals are equal, so it would not affect the totals. So the totals are equal, even though the debit should have been to accounts receivable instead of accounts payable. All right, now the adjustment for a depreciation of $3,260 was journalized as a debit to depreciation expense for $3,620 and a credit to accumulative depreciation for $3,260. So no, they're not equal. And in this situation, the debit side would be higher than the credit side. And it'd be a difference of $360. All right, so at the end of chapter 2, we talked about horizontal analysis, where we are comparing year to year. In this situation, we're going to discuss a different type of financial analysis where we can do a vertical analysis. So again, horizontal analysis, it was exactly what it was kind of horizontal. We would compare totals from one year to another, or from one company to another across the board, hence horizontal analysis. Well, in a vertical analysis, we still can compare year to year, but we're really looking at it from a vertical point of view. So the vertical analysis is when comparing each item on a financial statement with a total amount from the same statement. Okay, so we're not comparing one year to the next. We're comparing totals within the same statement, and we're comparing them vertically. So in a vertical analysis of a balance sheet, each asset item is stated as a percentage of total assets. Each liability and owner equity item is stated as a percent of the total liability and owner equity. In a vertical analysis of an income statement, such as here, each item is stated as a percent of revenues or fees earned. So here we had total revenue. So then what they would do is they take the expense and reported as a percentage of revenue. So in this situation, wages expense was paid out of 32% of revenue. Okay. That's kind of how you look at it. So I'm trying to word it away. Right. So quickly, how they came up with a percentage. You would take the total expense. So in this example, wages expense of $60,000 and divide it by the total amount of revenue. So 60,000 divided by 187,500 is 32%. Okay. So wages make up 32% of the total revenue, or total revenue, all right, paid for wages was 32% of revenue was used to pay wages. Okay. 8% of revenue was used to pay rent expense. 6.7% of revenue was used to pay utility expenses. All right. So it all adds up to where 49.3% of total revenue went to pay operating expenses, meaning that your net income is comprised of 50.7% of your revenue. Now, you could take this vertical analysis, all right, and here what they did was they took a vertical analysis and turned it into also a horizontal analysis. So what they did was they took 2 different years, did the vertical analysis of 2 different years, and then cross-compared them. So here you're doing a vertical analysis and then a horizontal analysis. So we did the vertical analysis looking at what percentage of expenses was paid out of revenue, what percentage of revenue went towards that expense, however it needs to work in your brain. So what percentage of revenue was used to pay these expenses, and what percentage of revenue was left over to generate net income. So that's your vertical analysis. And then you would do that for both years. And then you compare the years across the board, and that would be your horizontal analysis. So in the year ending in 7, only 47.2% of revenue was used to pay operating expenses. But in year ending in 8, 49.3%. So there was an increase. And you can do that for each type of expense. All right, so that is it. So we can quickly do this example exercise, but this is into the chapter for the adjusting process. If you guys have any questions or concerns, feel free to email me. But let's do this vertical analysis real quick before we end the recording. So it says to prepare a vertical analysis of the Fortson Company's income statements. So let's quickly do that really quickly. So you see here, they took the income statement and they did the vertical analysis. So here you have your total revenue and your total expenses. All right. So 62% of your revenue went to pay your operating expenses. So only the remaining 38% was used to generate your income. And the previous year, 56% of revenue was used to pay your operating expenses, leaving 44% of the revenue to go towards your total income for the year. And now it says do a vertical analysis indicating a favorable or an unfavorable change. So an unfavorable change occurred because your total amount of operating expenses increased, decreasing income from operations as indicated. So you see here, more revenue was used for income in year 1 than revenue was used for income in year 2. So this would be an unfavorable change. All right, guys, that's it for chapter 3. Look forward to chapter 4 that will be posting sometime next week when we start our new learning module.